Hello everyone. So today we'll discuss a topic which is often difficult to comprehend, that is the relationship between bond prices, interest rates and yields. Now to start with, let us understand what do we mean by a bond. So a bond is a financial instrument. It is actually an instrument of debt. So there are two kinds of financial instruments. One is a debt instrument, one is an equity instrument. So this bond is actually a debt instrument. So debt in common language means loan. Okay, so the first thing that you have to understand is that if I am issuing a bond, then I am actually the borrower, and the person or the entity who is buying the bond from me is the creditor. So generally, the entities which issue the bonds are governments or corporation. So when governments or corporations issue bond, they are essentially borrowing money from investors for a specified period of time with the promise to repay the principal amount at maturity and make periodic interest payments along the way. Okay. So basically, in case of a bond, there is a principal repayment as well as, so in case of a bond, there is a principal repayment at maturity plus regular coupon payments. So this coupon payments is listed on the bond itself. For example, an entity or now you as an individual can also buy government bonds. You can also invest in government bonds. So you might buy a $1,000 government bond with a coupon of 3% paying out annually. So this dollar 1,000 is actually called as the face value of the bond, and this 3% is the coupon rate. So this is the annual coupon rate. So 3% of $1,000 is $30. So that means every year you will get $30 for 10 years. That's the tenure of the bond. And at the end, you will also get your $1,000 back, which is also guaranteed. Okay. Now, a very important concept to understand here is that of bond yield. So what is a bond yield? So bond yield is the return that an investor realizes on that bond. An investor here is the person or the entity who is buying the bond. So how much money he is making by holding that bond. Now there are several types of bond yields such as current yield, yield to maturity. In this discussion, we'll focus on current yield, which is the most simplest concept to understand here. There's a yield to maturity, which is often abbreviated as YTM, is a much difficult concept and which we would be learning in another video. Okay, so another thing that you have to understand here is that once bonds are issued, they are often traded on exchanges, which are the secondary markets like other securities. So you all know that once a company is listed first time on a stock exchange, so that is called as an IPO. So that's an initial public offering that is concerned with the primary market, and then its shares are traded on the stock market, which is called as the secondary market. Similarly, bonds are traded on exchanges, which are the which part of the secondary markets. So the prices of the bonds also rise and fall with supply and demand. Okay, so by prices here we mean the face value of the bond and not the coupon payments. Okay, so generally the bonds are specified with fixed coupon rates and fixed coupon payments, but in the end we'll also discuss bonds which have a floating coupon rate. Okay, so in the context of bonds which give a fixed coupon payment, we have the concept of current yield, which is obtained by dividing the annual coupon payments by the bond price. Okay, for example, in the earlier case, so if the price of the bond remains the same, that is dollar 1,000, and the annual coupon payment is dollar 30, then what is the yield of that bond? So it is 30 divided by 1,000 into 100, so which is 3%. So which is basically a reverse way of saying that since the coupon rate was 3%, hence the coupon payment was $30, and hence the yield turns out to be 3%. Okay. Now, what happens if there is a change in the market rate of interest? So we are not saying that the coupon rate on the bond has changed. What we are saying is that there is a change in the market rate of interest. Now, what leads to a change in the market rate of interest? So mostly it's actions the- by the central bank, which in our case, which in the case of India is the Bank of India. So suppose the Reserve Bank of India reduces the repo rate from 3% to 1%. So this is a hypothetical example. So what is the repo rate? So repo rate is the interest rate that bank charges from commercial banks, and basically the other interest rates, the other lending rates are also linked to the repo rate. Although there is some lag between the transmission of a monetary policy action and the actual lending rates that you experience from commercial banks, but for the sake of this example, let's assume that the Reserve Bank of India has reduced the repo rate from 3% to 1%, and now all interest rates that are being offered are linked to this repo rate and hence 1%. So if there is a bond trading on the market that's paying 3%, so what is this bond? So the bond that we had in the beginning, now that is still paying a coupon payment of or a coupon rate of 3%. So it will become very attractive. Why will it become very attractive? Because the newly issued bonds or the other assets will offer 1% interest rate, because now the market rate of interest has changed, or it will gravitate towards 1% because it is the benchmark rate. It is the rate that the RBI is charging from the commercial banks. So the bond that you are holding, which is giving 3% coupon rate, suddenly will become very attractive. So as we know, the forces of supply and demand will play here. Why? Because as we discussed, that the bond that you hold is also being traded. It's listed on the stock exchanges. Okay, so its price will fluctuate. So now, since the bond that you have held, its price, it has suddenly become very attractive because it is giving a coupon rate of 3%. So its price will go up. Why? Because its demand will go up. Now the key thing here to understand is that because you are paying more of it, the yield that you will get from the bond will now become less. So this is a critical thing to understand here, is that the increased demand for the bond results in rising prices and falling yields. Now, let us illustrate this through an example. So suppose the price of the bond goes up from $1,000 to $1,100. Now, what is the reason? The reason is an increase in demand for this bond. Why? Because this bond has become very attractive. So obviously its demand will increase, hence its price will increase. So now if we calculate the coupon, the current yield here, so that will be, so the coupon payment is still, it's a fixed coupon payment, it is still 30, but now the price is 1100 into 100, so it is 2.73% now instead of 3%. So you're not getting 3%, you are actually getting 2.73% because you are getting a coupon payment of 30 on a at a bond price of 1100. So the bond price is no longer 1000, it is 1100. So at a higher price of the bond, we're still getting 30. So the yield has gone down from 3% to 2.73%. So a current yield of 2.73% means that a bond with a market price of $1100 and an annual coupon payment of $30 will give an yield or a return on investment of 2.73% per year. So this implies that if an investor purchases the bond at the market price of $1,100 and holds it for 1 year, the coupon payments received over that period would represent an annual return of 2.73% of the initial investment. It is very important to note here that we are talking about the current yield and we are not taking into account the bond's maturity date or any potential gains or losses upon sale or redemption. Okay, so we are just providing a snapshot of the bond's yield at a specific point in time, considering its coupon payments and market price. Now, suppose the reverse happens. Suppose the RBI increases the repo rate, let's say from 3% to 5%. Now, your bond is giving an annual coupon payment of 3%. So, in this case, the bond will become less attractive. Your bond that you are holding will become less attractive. Again, the forces of demand and supply will come into picture. So the demand for this existing bond would decline because newer bonds will be launched at 5% rate of interest, or other assets will give 5% rate of interest. So the bond that you are holding that is giving 3% will now become less attractive. So now if it will become less attractive, so basically So the flow here is that your existing bond, which gives a coupon payment of 3%, has become less attractive. So its demand will fall. So its price will fall, but the yield will increase. Now, why the yield will increase? Again, you have to understand that the coupon rate or the coupon payment remains the same, which is $30. So now you are getting $30 on 900 instead of 1000. So you're getting a higher yield on a lower price. Okay, so in this case, so basically the yield has gone up from 3% to 3.33%. So this is a very critical concept in economics and finance, that bond prices and bond yields are inversely correlated. Now, you might have come across news clippings or news items which says that because of certain action, the bond yields on government bonds have risen. Now, this is actually undesirable in most cases. So this often becomes confusing, that if bond yields are rising, then why is this an issue? So this is an issue from the government's perspective. Why it's an issue from the government perspective? Because higher yields on the government bonds, which is the debt for the government. The government has issued the bonds, so it has to pay annual coupon payments on those bonds and also give the principal repayment at the time of maturity to the investors who have purchased the bonds from the government. So if there are higher yields on the government bonds, because of forces of demand and supply, it would mean that the government has to pay more in interest because the prices of the bonds have come down. Okay, so higher yields is the case that happens when prices have come down. So nobody wants to hold government bonds. That is why the prices have come down. But the government would have to honor its commitment, so it will have to. So basically, for example, in this case, it would be paying 3.3% as the yield instead of 3% earlier because the prices of the bonds have reduced. So in most cases, this is something that you have to remember, that rising yields on government bonds is undesirable. Why? Because the government has to pay more in interest. So now it has become expensive for the government to borrow. That means higher borrowing costs would discourage investment and hamper economic growth. Okay. So also when bond yields rise sharply, and the reason for that is reduced demand, so it can signal a lack of confidence in the country's financial stability or the ability to repay its debt. Why are investors not? Uh, so the reason why the yields on government bonds have increased is because there is a reduction in the demand for government bonds. Now, why is that the case? It could be the case that investors have lost confidence in the country's financial stability or the ability of the government to honor its obligations. So, in that case, there will be a reduction in the demand for government bonds. So, this is obviously not a good thing. One, because it signifies that there is a reduction in investor confidence, and second, it has made borrowing for the government expensive. So say, what will central banks do in this case? So central banks can engage in bond purchases, which is commonly known as quantitative easing, to reduce yields. Now, how does that take place? So quantitative easing basically means that RBI will buy bonds from the market. Which bonds? Government bonds. So the bonds which have already been sold are there in the secondary market. They are being traded in the secondary market. So the RBI, the Reserve Bank of India, will buy these bonds from the market. So if it buys bonds from the markets, what will happen? The quantity of those bonds will reduce. The quantity of those bonds will reduce. So that will push up bond prices and lower the yield for the government. So this action will basically help lower borrowing costs from the government and potentially ease market tensions. Okay, so if RBI will buy government bonds from the market, actually the demand for the government bonds will. So basically, the supply of the government bonds has decreased. Okay, the supply has decreased, so that will push up prices. That will push up prices, and that will help reduce the yields and help reduce the borrowing cost for the government. Okay. Now there is another category of bonds which constitutes a smaller proportion of the debt market, which are floating rate bonds or rate notes. So what are these? So these are bonds whose coupon rates are periodically adjusted based on a reference interest rate. So in the earlier case, every time, even though there was a fluctuation in the price of the bond because it was being traded on the secondary market, the coupon rate remained the same, which was 3%. But in the case of floating rate bonds, the coupon rates are periodically adjusted based on a reference interest rate. Now, what is this reference interest rate? It is typically a benchmark interest rate, such as LIBOR. LIBOR is the London Interbank Offered Rate, or the US Treasury Bill rate. So, US Treasury Bill are the so by when we say Treasury bills, those are government bonds in all countries. So treasuries are government bonds in all countries, not just in US. But we take the interest rate that the US government is offering on its bond as the reference interest rate because US is a major financial market. So I'll encourage all of you to read about. We'll discuss about LIBOR. It's an important concept. So in this case, in the case of floating rate bonds, so the coupon rate is not fixed, but it is actually linked to a reference rate. So it keeps on changing. So, for example, if a floating rate bond has a coupon rate of LIBOR plus 2%, so this 2% is it's a predetermined spread. So we are saying that if I am issuing a bond, so I want to protect my investor against any potential fluctuation in the market price of the bond. I do not want the investor to lose. So I am saying that so whatever be the London interbank offered rate, I'll offer an interest rate 2% greater than that. For example, if the LIBOR rate is 1.5%, so what is the variable here? The variable is LIBOR rate. That is the reference rate. So if it is currently 1.5%, my coupon payment would be 3.5%. So as government, I'm offering this coupon rate. Okay. So the LIBOR rate can fluctuate and hence the coupon rate on the bond will fluctuate. So now what is LIBOR? So LIBOR is the London Bank Interbank Offered Rate, which is a benchmark interest rate used as a reference for a wide range of financial instruments and contracts. So it basically represents the average interest rate at which major global banks in London are willing to lend to one another on an unsecured basis in the interbank. So LIBOR basically serves as a key reference rate for various financial products, including loans, bonds, derivatives, and other assets. And it's basically a reference rate that is used as a benchmark rate for different kinds of financial assets. I'll encourage all of you to read more about LIBOR, how it is determined, how frequently does it fluctuate, and what and has there uh, been a decline in its relevance in the last few years. So, in the case of floating rate bonds, as we discussed, so there is an incentive to provide investors with a degree of protection against changes in interest rates. So, when interest rates rises, so we are assuming interest rate rises, that means the LIBOR is rising, uh, or the market when the market rate of interest rises. So, LIBOR, which is often linked to that market rate of interest, or market rate of interest, which is linked to LIBOR, so if it rises, then the coupon rate of the bond will also increase, which helps to maintain the attractiveness of the bond relative to newly issued bonds with higher coupon rate. So that's what we had discussed before, right? So if the market rate of interest in the earlier case, it rose from let's say 3% to 5%, then the newer bonds which were being issued at 5% had become more attractive. Now in this case, what we are saying that the already issued bonds will also offer a rate of interest of 5%. So we want to maintain the attractiveness of the bonds that are currently being traded. So the advantage of the floating rate bonds are they are less sensitive to changes in interest rates as compared to fixed rate bonds. This is because the coupon payments of floating rate bonds are reset periodically, aligning them more closely with prevailing market interest rates. So this is about bond prices, interest rates, and yields. So this is a very commonly misunderstood topic in economics that if bond prices are rising and yields, so that means yields are falling, or if yields are rising, why is that a bad thing for the government? So I hope it's clear now. In the next video, which is related to this, we'll discuss how this concept is fundamental in understanding the Silicon Valley Bank crisis.